shit, I'm not ready. My microphone wasn't screwed in.
Drums.
Where's our drums? I'm not prepared for this. And again, like one of my lines coaching basketball just in a timeout yesterday was, hey, timeout, come here. Don't be surprised out there when a basketball game breaks out. And my microphone wasn't ready for a podcast that's been on my schedule all day. And I apologize to people. This is the Trader's Edge. I am Jim Iuorio. That's Bob Iaccino. Thank you guys. This is one of my favorite shows to do because of the live element to it. And you guys, the interaction we get is amazing. Please keep it up. I was going to say from our fans, but realistically, we're fans of you guys every bit as much as you're fans of us. So thank you for that. Bobby, so big rallies in the stock market. Is Santa Claus rally back on, or are we just spinning our wheels? Too early to tell?
I mean, it's too early. And we've got, it's that time of November when you could get kind of a low volume rally. And I'm not knocking the move we got today, but still 1% move. If you look at a chart, stuff still looks kind of sideways.
It looks kind of sideways to me too. Is there a level like a settlement of the weekly that'll make you a little more encouraged by Friday?
Yeah. What do you want it in, the NASDAQ or the S&P?
NASDAQ, I think, is more important. I usually look at the S&P, but I like NASDAQ.
25,506. That's
25,506 in the futures.
That's the futures, everybody.
Okay, and that's going to be above the weekly rotation zone, right?
It is. If we go to the QQQs, the level is about 618.42.
Okay, perfect. Which Robbie, it's about give or take, and then he gives it down to the absolute penny. Okay, well, I don't want to delay very much longer because I love our guests. And one thing I always say is that if you guys can have followed Bobby and I for 25 years in media and think that we're full of shit, and sometimes we think we are as well. But one thing you cannot deny is for some odd reason, we get outstanding guests, and today is no exception. We have the Deputy Chief Economist at First Trust, who's with Brian Westbury there, which I think the two of them together are the best team of economists that walk the planet. Let's bring in Bob Stein. You didn't run away from the gunfire of Chicago like Westbury did you? You're not a coward like him, are you? Do you still live here?
Well, see, I've never lived there, actually, so I didn't have to run away. So I live in Vienna, Virginia, about a dozen miles as the crow flies west of the White House. So, I keep away from Washington, D.C. The National Guard has settled it down a little bit, but I rarely go in. Yeah. So I never had to flee Chicago because I was never there in the first place. I love downtown Chicago. Yeah. It's one of the, especially in the summer, spring. I mean, not the winter, because
clearly not. Today winter came. Yeah. Right.
Yeah.
Criminals love it too, Bobby, just so you know.
Yeah. We get winter starting tomorrow. So on the East Coast. But yeah, I've never had to flee, but I love Chicago and I hope to see it revitalized at some point. And frankly, it's better than it was a couple of years ago. I mean, it's starting to turn the corner. We just have to keep the momentum.
I hope so. And tell me this, when you were with the government, what position did you hold? And did you work at the White House?
I didn't work at the White House itself. I worked at the Treasury Department. I finished up as the acting assistant secretary for economic policy in 2006, I believe. So I was at the Treasury Department 03 through 06. That was under Bush the Younger. I worked mostly for Treasury Secretary Snow, and then very briefly for Secretary Paulson when he came in from Goldman. That was a little bit of a culture change. Secretary Snow, not 9 to 5, longer hours than that. But you get calls from the secretary's office when Paulson took over, like 6 p.m. on a Saturday night, saying you got to come in, and I'm just firing up my grill, and I'm half in the bag already, and I got to go into meetings at the Treasury Department. And I'm thinking, I don't work at Goldman. They're not paying me Goldman money. It's time
government.
To get out of here. I've been around long enough. If I were going to have a favorable influence on economic policy, I would have done it already. So I spent 4 years at the Treasury. Before that, I spent 7 years on the Hill as an economist. My last two, I was in 2001 and 2002. I was the chief economist for the Senate Budget Committee. Look it up, gentlemen. We had budget surpluses those years. I'd like to take sole responsibility.
Sole responsibility. Yeah.
We haven't had a budget surplus since Bob Stein stopped being the chief economist.
There's no question. As far as Paulson goes, I live in the same town as Paulson. I always thought I'd run into him at places. He's a big guy, right?
Yeah.
I thought
big guy, smart guy, very gregarious. I'm surprised you don't. I mean, I think he's is he affiliated with ICE or some other organization? I'm not, to be honest, I'm really
no idea.
Not sure.
Bobby, did you know he lived in Barrington?
I did.
Yeah. Bobby, what do you got?
Yeah, I want to touch on Chicago real quick. I know that's not really what we're on here to talk about, but Goldman Sachs was stuck with about $75 billion in Chicago bonds. Now, I haven't paid attention to regional bonds like that in a long time. Extrapolate that a little bit for us, Bob, if you could. Does that matter?
Could it be a
does
canary?
it just matter to Chicago?
I think it matters to Chicago and as well as Illinois, greater Illinois, to the extent that I think, Pritzker's not going to let Chicago go bust.
Yeah.
He's just
going to buy him.
What's that?
Is he going to buy him?
Well, not personally.
He's going to take my money.
Well, if he has a good run at the blackjack table in Vegas again, maybe he'll have enough cash to do so. But I actually, he'll use, not personal money, but he would intercede if Chicago got into deep doo-doo like New York City did in the late 1970s. So here's the deal. Okay, there are 3 or 4 key states that have long-term fiscal issues. And let's go through them because I see Chicago as really as an Illinois issue or integrated together. So California has sunshine. There's always going to be new billionaires or centimillionaires who are willing to disgorge themselves of money to live in Southern California or Northern California, Palo Alto, whatever. They're just going to be
beautiful place.
Exactly. It's just so naturally beautiful that they can take care of their fiscal issues. Okay. New York State may have long-term fiscal issues, but sooner or later, God bless the environmentalists and all that stuff. They can't make the energy disappear. They can't make the natural gas disappear. So at some price point, the retired public employee workers are going to, force the state to loosen up their environmental restrictions. Okay, so that's what's going to happen there. Then there's Illinois. Okay, what's Illinois got? Okay,
me.
Yeah. So Illinois is
that'll do it.
confiscating the value of real estate. Real estate's an immobile asset, so they're gradually confiscating its value. So you want to know why Illinois real estate, generally speaking, I know there are exceptions, is basically flat over the past 15, 20 years. That's because everybody knows what's going to happen. The state and the city are going to confiscate the value of your real estate, an immobile asset, to pay for the public employee pensions. That's all that's going to happen.
So here's what I think is a possibility, and I think it's a remote one, but I want you to tell me if you believe it's possible. Is that, okay, there's Ted Dabrowski is running up against J.B. Pritzker. And J.B. Pritzker, anyone who ever talks to me, I say, he is not the governor of Illinois. He's the governor of Chicago. The rest of the state does not matter to him, and he will take all your money to prop up Chicago. Ted Dabrowski, on the other hand, will not. Do you see a scenario that it's possible that in 10 years' time, maybe 15, Bears move out to the suburbs, other businesses have been doing it in droves, that the world views the commercial part of what's Chicago, doing air quotes for people listening, as the suburbs where there's 10 million people, not the city itself, which is 2, and that will be just like a museum like in some European cities. Is that a possibility?
Yeah, I think that's a possibility, but don't they have a deal to build a new? Maybe I'm just behind my news on Chicago. Don't they have a deal to build a new stadium downtown?
But they haven't agreed to anything yet.
Not downtown.
What's that?
If you look at like the betting markets, it's about 70% now that it's going to be Arlington Heights, not
Arlington Heights is still where it is. Yeah.
Oh, that's bad news for Chicago.
That's a big deal.
It's a little crazy, Bobby, because they literally bought the land.
Yeah.
The McCaskies bought the land. So it would have to be a great deal to not build on their own land.
Well, the county and the state have been trying to tax the shit out of that land to punish them for even thinking of moving out of Chicago. Because again, I reiterate to all my Illinois friends, if you are outside the city limits by one step, the government does not care about you. Even the state government is about one city. But I don't know. If Ted could win, that would be wonderful. I really like Ted Dabrowski. He's a former bond trader.
Wait. Are you expecting him to win in 2026 for the governor?
No. I said it's a remote possibility, Bob, if you just listen. Our other guests listen. I said it was remote. But a possibility.
Interesting thing is,
I don't listen, especially the day before Thanksgiving.
Okay, good.
when I left Chicago, I had lived in the city limits for about, save for 4 years in Los Angeles, I lived in the city limits for most of my adult life. And as a working person in Chicago, it didn't feel like anybody gave a shit about us, Jim, to be honest.
But now that's changed.
I don't know if it's changed because I left.
Right.
In other words, I didn't wait for it to change, I guess. But, you just look at, Daley sold the parking rights going out the door to private equity, basically. And they just kept raising the parking rates. And there were meters popping up on residential streets that weren't there before. And I think he sold it for like 90 years or something so that he could leave office with a surplus. And then the second he was gone, it was right back in the deficit. It's very difficult. If you look for solutions to what's going on with the federal government, which I want to ask you about, Bob, then you got to look in the state governments and say, what are the solutions there? Like you said, California, people are leaving California despite how beautiful it is.
Yes, they are. But they certainly did during COVID for a variety of reasons. I expect that the number of billionaires in California will probably be higher a decade from now than it is today. Now, that's possibly endogenous, more people are going to make more money a decade from now. And so only a fraction of them will leave. So, net, they'll still come out on top. That doesn't mean their policies are good, but there'll just be enough people who want the sunshine.
No. To reiterate real quick, California has geographical advantages over every spot in the world, not just the country. There is no place that has the advantages that they have. Beautiful. So when people compare the Kansas and California did the same exact thing, you've heard that bullshit before, and it failed in Kansas, but it succeeded in California because California has advantages. Sorry to interrupt. I'll shut up.
They also, a lot of people don't notice, they tax estates very lightly or pretty much not at all. So if you have a high income flow, not a great place to be. But if you already have your assets and you're kind of, leisurely want to stroll down Laguna Beach Lane or whatever, then it's fine. Okay, you've got your money already. And they won't tax it on death very much. So they've got a little bit of a loophole there. That I suspect they're not going to close anytime soon because that would be tough for the state to handle.
So let's get out of this local stuff if we
could. Let's go national.
Ask me a question before you came on, and we've been talking about this for the last couple of weeks, given the performance of equities. So I know that you can't actually pick stocks or pick sectors, but what do you look at when you're looking at the economy and you say, okay, the Fed is talking about labor, but not inflation. It looks to me like the yield curve flattened a little bit today. Where do you go when somebody says to you, you're going to dinner, a friend goes, you're an economist. What the hell is going on?
Yeah, I say beats me. No, ask an economist. No, I'm kidding. So what I say is I think the economy is doing okay. And I mean that not in a positive sense. Like if I overhear my wife talking about our marriage and she describes it as okay, that's not okay for me.
Yeah.
Okay. So I aspire to more for my marriage than okay, more for the country and the economy than okay. Unfortunately, right now, the economy is just doing okay. Okay. For the third quarter, when that number finally comes out later in December for the third quarter, it was supposed to come out early October, government shutdown, postponed it. I suspect we'll be somewhere in the 3 to 3.5% range for real economic growth, but we'll probably come down to maybe 1.5% for the fourth quarter. And net, we're roughly 2 to 2.5% trend. Nothing great by historical comparisons. Unemployment rate's going to trickle up a little bit. Payroll growth's modest. Now, I'm going to do a little tangent here on payroll growth. I hope you don't mind. Everybody's up in arms, especially on the right side of the spectrum. Trump himself up in arms when prior to the most recent one, these tepid payroll growth numbers would come out. 50,000, 82,000, whatever. Okay, I'm just making up numbers here. What the heck did they expect in a world where the native population and the population of legal immigrants combined is aging, okay, going into retirement gradually, and we're cracking down, like it or not, okay, whether we like the policy or not, on illegal immigration. Okay, we went from 2.5 million population growth, not birth, okay, not birth, but 2.5 million population growth the past few years per year to essentially zero like that. What do you think is going to happen to payroll growth? I mean, half the people coming into the country, or at least 40%, were getting jobs, right? So that's about 100,000 jobs per month. So of course, payroll growth is slower. I mean, I would expect that if we stick with strict immigration policies and enforcement of strict immigration policies, like whether that policy is right or good or bad or whatever, then we should have payroll growth that's really low and frankly near zero. And it's not necessarily a bad thing. You know, the economy is growing, but it's growing modestly. I think next year it'll grow 2%, real economic growth. That's it. Just modest economic growth. Now, in that context, normally I would say, well, the equity market has room to go a little bit as long as we keep inflation, the lid on inflation. But there are two problems with that. Number one, we aren't keeping the lid completely on inflation. Inflation's come down a lot from where it was 4 years ago, peaking at 9%. Now it's roughly 3%. That's good. I actually think I'm mildly optimistic about inflation over the next year. To some people's shock, because I think the Fed is still modestly tight, and with a lag that will influence the inflation numbers, and I think energy prices will be down over the next year. So I think inflation may actually get down to the 2.5 range by the end of next year. However, so that's but it's not going to stay there. Okay, it's going to come back up pretty soon after that, 2 years later. And we're going to average higher inflation over the next decade or two than we did pre-COVID. We're not consistently 1.5% inflation like we were pre-COVID. The other problem is this, and this is by far the biggest problem for the equity markets. We're simply overpriced. It's just that straightforward. Okay, you look at the earnings yield on stocks, and it's roughly 4% if you use trailing earnings, and that's not a favorable place from which you're going to have a big rally. And we have been going up. Equities have been doing great. If you look at the Shiller price earnings ratio, taking 10 years trailing earnings, the average of the past 10 years, back adjust those back earnings for inflation, it's at 40. Okay. So historically speaking, the forward return on the S&P 500, including reinvested dividends, over 10 years, okay, when the S&P, with the Shiller price earnings ratio is already 40, it's essentially zero. Now, I take that with a grain of salt. And the reason I do is because we don't have a lot of historical examples of a 40 Shiller PE. So I actually think the forward return on equities is more like 7%. I mean, compared to Goldman Sachs, they're saying 6.5%. I'm a wide-eyed optimist, okay? But 7% is not that strong compared to the historical average. And it's kind of weird. Like Goldman Sachs says, 6.5% per year over the next 10 years, but something like 11% over the next 12 months, which is possible. Like,
sure. But why? You know what I mean? I'd like to break them down on that because it's absurd. I want to steer it to another thing about this. And because I want you to finish your rant, but I want you to add the effects of AI, because here's what I believe. I'm never one who's normally scared of a new technology. I believe that in Adam Smith's invisible hand, this time I am scared of this new technology. I think it is affecting the labor market already. And when I look at future inflation, I don't see how, if the productivity gains that I expect from AI and the lessened need for labor, particularly white collar labor, that I don't see how inflation comes back. Can you put that all into the stew you're mixing and tell me what you think?
Yeah, well, I could talk about this for a while. So I'll try to keep it short.
No, don't keep it short. I'll take a nap.
Don't
Don't worry
keep it
about
short.
And I like how you call me out for ranting. Okay.
it. No, I love a good rant. To me,
when
that's
you-
a compliment.
Yeah.
Can
no,
I stop
totally.
you
Like, I'm
guys
from
for
New
one
Jersey.
second, Bob?
Oh,
I
what do
want
you
to
got?
stop you guys for 1 second because related to what Jim just said, there's a question in the chat from It's Stock Charts, who's Remo. Will investments in AI be enough to boost productivity growth and offset slower labor force growth? So
that all
basically, you could
belongs-
roll that up into one
all
rant.
belongs in the same thing. Love it.
I'll lead
Yeah.
with that. And I think the answer is yes. But the boost of productivity growth, I think, is going to be more gradual than we experienced in the mid to late 1990s when the original internet age kind of transformed a ton of things at once, both within businesses and to consumers. It did that all at once. And now it's a little more gradual. It's here and there. I have noticed the layoff notices just like everybody else. Context is important. In a normal week in the United States, when the economy is doing well, normal week, just look at initial unemployment claims. They run 200,000 plus per week. Normal week, okay, when things are good. So when things are running well, 10 million plus people per year get fired. Okay, I know when I say the word fired, people say, "Oh, Bob, that's a little too harsh." You mean laid off? Okay, whatever. Okay.
Whatever. Yeah, pick your poison, right?
Exactly. Okay. I'm constantly edited by compliance. I said fired. No, they're laid off.
That's why we like you. Yeah, right.
Okay, whatever. So yeah, 10 million people plus get fired in a good year. So when you see all of these headlines about Hewlett Packard or Amazon, whatever, put that in the context of 10 million people per year. So it's very easy to identify the particular jobs that are being lost to AI. And I do think at the beginning stages of AI, we may run into an issue with where AI is more of a substitute for labor than a complement. However, I'm not sold that that's the medium or long-term effect. We're all old enough to remember the mid-1990s or the early 1990s. You know, right after Al Gore invented the internet, there were all these stories about like replacing all these jobs with the internet. Like, remember how tough it was to get an airplane ticket? Okay, when you used to travel, like if you wanted a ticket quickly, you'd have to go to an office and stand in a line, brick and mortar, like literally. No, like where like paper tickets now. Like it's just like everybody has an app, and if you don't, it's easy. It comes from a machine. There are very few people doing all of that operational stuff. It's very easy to identify the particular jobs, especially up front, the particular jobs that are going to be lost from AI or any innovation in technology. It's sometimes a little more difficult to figure out where the money is going to flow to, where the jobs are going to flow to, because they haven't been created yet. We're not used to having those jobs around. So, 100 plus years ago, it was very easy to see the farmers that were losing their job from higher tech, higher productivity. It was hard to imagine where they were going to go. Over the past 30 to 40 years, we've lost, relative to the population size, a lot of manufacturing jobs because we simply don't. Manufacturing is so productive. We don't need as many people in manufacturing. Somebody's got to tell President Trump this.
I've been screaming it. Bringing back manufacturing jobs means bringing back people who are building a warehouse and then they're done, right? Or building back the factory. Yeah, right.
Exactly. So it's difficult to identify the new jobs that will be created as this creative destruction takes hold. So I'm not sold that AI is going to be, maybe in the short run, it's going to be more of a substitute than a complement to labor. But I think in the medium to long term, I'm not sold that it will be. So what do I mean by being a complement to labor? Okay. Obviously, the person who in the 1990s went from working with a typewriter to a computer hooked up to the internet became more productive. So you didn't need as many of them maybe to do those jobs, right? But then companies quickly realized, wait, this guy or gal with a computer hooked up to the internet is a heck of a lot more productive than one who is with a typewriter. So let's get more of them because they're doing more stuff. And we ended up having a job boom in the 1990s and unemployment getting to like the lowest that it had been in like 4 decades. So how did that happen? It was a complement to labor. I'm not sold that AI is going to be purely a substitute, despite the fact that we can see the jobs being lost. The other thing that's really important is what I think is going to happen is the people who lose the most jobs are going to be on the lower rung, the lower to middle rung of the college educated. Okay. So not the most productive people who come out of college. So and this is part of what's going on with Mamdani. Okay, I think we saw the Mamdani effect here. Like, and I've gotten this from elsewhere on the internet. This is not an original Bob Stein thought. In fact, I don't think I have any original thoughts.
Neither do I. I just take yours and pretend like they're mine. Go on.
Yeah, whatever. So let's say you went to Vassar, okay, and you graduated 8 years ago, and you had a degree in whatever studies program they had, victim studies, and your parents were graduates of Vassar and Oberlin, whatever, and they went to New York City and they did pretty well. They worked for a lot of marketing firms and doing this and that, whatever. You, at the age of like 28, like you're easily replaceable. You really don't have any value. You're gone. Okay. So they did everything their parents told them what to do. And then they're sitting there without a job or less pay than they thought they are entitled to based on the fact that they got this degree. And they're watching, and again, okay, this thought comes from elsewhere, but I agree with it. They're watching the kid who went to, got a computer science degree from Stony Brook, make a heck of a lot more money than they did. Okay. This kid couldn't have gotten into Oberlin or Vassar. Why am I serving them coffee? Okay, so there's a little and I've got student loans where they're paying theirs. So there's a little bit of frustration there because the kinds of people being replaced are like the unproductive segment of people who go to college and think by virtue of having gotten a college degree, even though they didn't really learn anything there, maybe they didn't even go to class, they just went to protests and stuff, that they're entitled to earning a middle to upper middle class standard of living, but they can't, especially in New York City.
Yeah. Bobby?
Real quick, Luis, can you put up Widge's comment here?
Oh, and let's take a time
I've got
out
a question after this.
Question.
But
yeah.
Good commentary. What I've seen in latest reports, labor participation is growing despite the immigration issue. Are people coming off sidelines to maintain benefits reflected in a higher U3? For people who don't know, U3 is the unemployment rate that you hear announced with a particular number, unemployed people divided by labor force.
Yeah, this is a fantastic question. It's very
You always ask fantastic questions. Thank you, Wid.
Yeah. Yes, exactly. So if you really go into the guts of the labor reports, like I do every month, the odd thing you see is that the number of native-born people who are working or looking for work is up. The labor force among native-born population is up. They're up, I think, maybe 2 to 2.5 million so far this year, or over the past 12 months. Whereas the foreign-born population, that's how they describe it. And this includes legal. Okay, so but that's down about 1 million so far this year, since January, since the strict crackdown on illegal immigration. So I think to some extent there are people who are coming off the sidelines and looking for work because some employers are going to have to raise wages and have had to raise wages to get the person, the native-born person, to do what they were paying less for from the foreign-born illegal workers. So, like, let's say you had, you ran a small business and you were installing hot tubs, or you were installing heating and cooling units and stuff like that. You might have an illegal employee who's working off a false Social Security number, like with a fake name and everything like that. Well, now, that person might have been rounded up. Again, I'm not here to debate pro or con. This is just the economic facts. Well, you've had to pay higher wages because you still have demand for heating and cooling units, and you're going to have to pay a little more to the native-born worker. Now, we only have like 8 or 9 months of this data. It's so far this year. So I'm really eager to look at this a year from now, 2 years from now, to see whether there's a noticeable difference. There's a lot of statistical noise in all of these data series over such a short period of time, 8 or 9 months. But my best guess, my gut is that, yeah, something's happening with the native-born population, and that's why the labor force participation rate has remained elevated relative to the lows we previously set. Now, here's the key point. A lot of people, it's still lower than it was 25 years ago, the labor force participation rate. I believe that much of it, not all of it, much of that is related to the aging of the population. It is true that like old farts like me who's 60, as a 60-year-old, I'm working more than 60-year-olds a generation ago. Okay, my 60-year-old cohort, but I'm still working less than I was when I was 40. Like the 60-year-old today are working less than they were when they're 40. So the aging of the population has been, that drop in the labor force participation we should see has been buffeted somewhat by more intense participation on older workers, but they're still participating less than they themselves were working 30 years ago.
That's fascinating. Let's take a quick time out. Luis, can you put the banner up? It's halfway through the show. You guys know what I'm going to make a pitch for, and I so appreciate the support you guys give us. There is a favor to do for us, and that's to scan and try out Tradier Pro, their options trading platform. We talk to people who've been trading options for decades, talk to people who've been trading options for hours, and all of them say the same thing about Tradier Pro, is that it is intuitive, it is awesome to work with, and is just a great system. And you get 3 months for free just by scanning that code. If you do it as a favor to us, we greatly appreciate it. If you love it, more power to you. Thank you guys very much. And now back to the show. I'm getting to be good at this journalism thing. I could be a pitch guy. What do you think, Bob?
Absolutely.
Thank you.
Absolutely.
Right. Okay.
Yeah.
There's one thing. There's something
you
I
sell
want.
it, I'm buying.
Damn straight. There's something I want to sell to you right now, a thesis, and I want you to comment on, is that sentiment numbers are going down. At the same time, equity markets were going up. There's all these other economists looking at that going, can you believe they're normally so correlated? Sentiment numbers are going down despite equity prices going up. I challenge that thesis. I think sentiment numbers are going down because equity prices are going up. Let me finish. Is that I think the non-asset holders, the 60% who vote in, people like Mandami, are sick as shit about not making any money, and guys like I'm making everything. Do you agree?
Absolutely.
Yeah.
Absolutely. I 100% agree. And by the way, just so that the viewer knows, if I disagree with something, I have no problem disagreeing. So I'm not yanking the chain. And absolutely, I would disagree. I completely agree. We cannot get out of this. Everybody's complaining about the economy right now. They were complaining about it last year. It wasn't awful last year. Okay, it's not awful this year. This is not like a Biden-Trump issue. Okay, it's pretty much the same. And people were expecting like some quick fix no, it's like everybody knows through social media and the interwebs and all that stuff what's going on in everybody else's lives. And they pretty much mostly see all the good stuff on the Instagram feeds and everything going on in everybody else's life. And they're more and more jealous and envious of their neighbors, their friends, their colleagues than they ever have before. And we can't fix it. It's like we could grow like 3% per year, real economic growth without a recession for the next decade. Okay. And people are going to be miserable a decade from now. They're totally miserable. And the people without assets are going to be even more miserable. And that's going to represent a lot of those Mamdani people who went to college, got ripped off by the academic class, got abused and used as mules for federal money so that the academic class could live fed on the land. And they're just mad at everything. They can't believe they were misled. And
rightly so.
Yeah,
right.
so we cannot fix confidence. That's why when I joined First Trust 19 years ago, at the end of bottom of our Monday morning outlooks, we publish the first day of every week, obviously Monday, sometimes Tuesday after a holiday. We have a data table. And I went to Brian like a few years in and said, why do we even forecast consumer sentiment and consumer confidence? Like, why do we even try? Like, who cares? It's like, how do you feel? Okay. Like, whatever. So we just stopped putting it in our tables. Like, I don't even try to forecast it. Like, it's not important to me, but except from a long-term standpoint where you're not going to be able to fix it. Like I don't see a boom in consumer confidence like we had in the late 1990s into 2000 and that boom, like for my remaining career. And I don't intend to retire anytime soon.
Bobby, before we go, though, their sentiment number should have a height thing on it, too, because I'm angry most of the time, and I think it's because I'm short. Like if it says, if you're 5'8" and angry, they should throw that out. You have to be 6'2", and then it's fine. Bobby?
I'm angry all the time unless I'm standing right next to Jim because I'm about a quarter of an inch taller than him.
True story.
I want to read Widge's
I might be
comment
3/8 of an inch taller.
3/8.
Nice,
I agree.
nice.
I want to read Widge's comment here, and I also want to share my screen here, Luis, because Widge posted this on Twitter along with this comment. Much of the labor participation rate shortfall over the past 25 years is actually the lack of participation from teenagers. And we could go really deep down that rabbit hole talking about minimum wages and things
Child
like that.
labor
Minimum
laws.
wage laws,
Yeah.
just absolutely horrendous. But if you look at this table, to Widge's point, you can see that the civilian labor force, or let me go to the employed data there versus the unemployed, and then look who's not in the labor force, and you could see the shifting numbers. So the employed is just crawling higher from July through September. But the unemployed in the labor force is not in the labor force is shrinking. The unemployed is growing. So I thought this was a good chart to put up when I saw that Widge threw it up on Twitter.
Could I add some color to that whole idea about teenagers? And
Yeah.
it's actually teenagers are people in their very early 20s. So there are two factors going on. Number one, a larger share, and this might have shifted a little bit since COVID, but I'm comparing today to 25 years ago, not 3 years ago. 25 years ago. Okay. So a larger share of people in that like older teen, younger 20 age group is going to college than 25 years ago. Okay. Now, there are two reasons that affects the labor force. Number one, for any given person, if you're going to college, you're less likely to be in the labor force than if you're not going to college. Okay. That's very straightforward. But there's another thing going on, which is that kids who are going to college today are less likely to be working than kids who were going to college 25 years ago. So not only is it a larger share of kids going to college that's affecting it, but just like, 25 or when I was going to school in the mid 1980s, okay, I went to Georgetown. Here, it's so long ago. Georgetown actually had a good basketball team back then. That's how long ago.
Yeah.
Okay.
Yeah.
So back then you had a lot of kids who were work study or just like had a side job. Like I wasn't even work study, but I had a side job just to earn money because my parents were stingy. Okay. Like I'm jealous of my parents now. They were so I can't get away with being stingy. How'd they do it?
Times have changed, man. Times have changed.
Exactly.
Yeah.
Maybe like beer's more expensive now or whatever. But like I worked for my own money, and kids today, the upper middle class has gotten so much wealthier that an upper middle class kid going to school today, going to college today, is less likely to work than an upper middle class kid in like 1990 or 80 or 2000. So that's affecting the labor force as well.
I got a story that sort of reflects that. My brother-in-law he's a barber, and he does well. I mean, they do great. They have a really good tax plan when they're barbers. A lot of customers pay cash, not important. But he was telling me one day that he was, we're at a bar having a drink, and he said, yeah, my daughter said something to me, and I'm like, what do you think? I'm made of money? And she goes, well, I mean, you have money. And he goes, how much do you think I make? And she goes, I don't know, $500,000, 750,000. That's what this like 19-year-old kid thought he made.
We need to teach economics.
Like, what? He goes, he said, I'm not your Uncle Bob's friend, Jim. I'm a barber. No, I made that part up. But I wanted to talk a little bit about the AI stuff because my stance on the AI, and Jim and I have talked about this a lot, and I was glad he brought it up, because I think AI will replace a lot of jobs. I just don't think it's going to happen very quickly. And I was glad that you said it that way, because it's a little bit more complex than, hey, we will put up a web page, buy there now. It just seems more complex to get AI to actually replace skilled workers. Maybe I'm being naive. Well, my question is this. I always see these things, whether it's the Industrial Revolution or the internet or anything else, as it's almost like musical chairs, right? Everybody's kind of going around. At one point, a couple chairs get pulled out, but they always put a couple more chairs back in. Is AI the thing? Because I'm afraid it might be the thing where the chairs finally don't get put back in.
Well, here's the deal. Like if someone is going to earn the extra profits associated with economizing on labor, right? Like if they get rid of these jobs, but they're earning more money, someone is going to earn those extra profits. They're going to want something with that money. A lot of what they want might be things that like the people who are laid off aren't going to provide, but it might be like more gourmet dinners and more restaurants. It might be something related to aesthetics that can't be easily replaced by AI.
My brother-in-law will tell you can't get an AI haircut anytime soon.
Well, more artistic types of landscaping, you know, like patios built, outdoor stuff. All this stuff could be we're on the huge uprise because people are going to be buying things who are making money from AI. That's what you mean, right?
Yeah, that's right. Like somebody might hire a bartender for a party when they have like a large dinner party. You know, let's say you're going to invite 40 people for a Christmas party at your house. Okay. Sometimes some people are like, hey, everybody's on their own. Yeah. We'll put everything in the coolers. And okay. Well, let's just hire a bartender. You get them up. Okay. What if you hired your own musician for the night?
Well, I did just a couple months ago, right?
Bingo.
Yeah.
So you're one of these upper middle class, bourgeois people who are like when my parents had a dinner party, they didn't hire a musician, right?
Yeah, mine neither, right?
Yeah. So why not hire a musician? Like there are going to be people who get these jobs because of the extra wealth generated by AI. And these jobs might not pay poorly, but you might have more like in-home entertainment in that sense, like things that were not reachable or even thinkable by as many people a generation ago.
But before, Bob, I want to give you this question, and then I want to wind it back to where the investment opportunities are. But I will say this, all the worries and trepidation I've had about AI, which have been very, very real, this has been the single best conversation to bring me back to what my thesis always has been regarding technology for my entire lifetime, that where the visible hand comes in, he knocks one thing down and creative destruction starts. And I love what you're saying. And I think that is an enormous takeaway from this particular episode. Bobby? Yeah.
So I guess that leads to the question, and this is not a question I don't think you can honestly answer, but I just want your opinion. The way you described it, does that mean the sort of wealth gap gets wider? There's more people who can afford to hire the bartender and more bartenders?
I think to some extent, okay, it's not strictly wider or more narrow, but I think that AI could have the effect of compressing the way it's going. Like you're probably not going to AI your ditch digging, your house cleaning, your lawn mowing, and things like that. And so, like if you maintain a strict immigration policy, then the native population that doesn't have a college degree might actually earn some more money relative to the unproductive college educated, like we previously discussed, who got their Vassar and Oberlin degree and now are serving lattes at Starbucks or Pete's.
Makes good sense. So tell me this. So if for the investment part of it, and Bobby, this is going to be a question to you and to Bob. If you take the companies that are directly involved in AI out of the equation, because we all know what they are, Google now, which by the way, has been my biggest holding for 7 years, not because of AI, but because they are the CIA. We've talked about it at length. But anyway, now Google's going through the roof because of the TPU chips, which I'm now an expert on. I don't know what the hell a TPU chip is, but I'm going to talk like I do. But anyway, so if you take all the directly involved AI companies out, what are the next level of industries and sectors that are going to be able to utilize AI to make themselves exponentially more productive, boost share prices up? Where does the money go?
Wow, is that for me?
Yes, for you first.
Yeah, I mean, part of me thinks the warehousing industry, things that are not necessarily immediately client facing, delivery, transportation. I've been someone who for many years has been skeptical about self-driving cars. And I'm still somewhat skeptical of self-driving cars, with an exception now. What about trucks at night?
Shipping,
long range shipping at night, things like that. Going through Wyoming, Montana, a lot of the other states that, especially at night, I think that's going to get much more efficient and effective, and it's going to be AI related. So we'll see about the innovation over the next decade, but it might become normal to like just drive by trucks that are carrying big loads, like in more rural areas in particular at night, that have nobody aboard.
It's amazing. Bobby?
Yeah, I think I agree. One of the things that I've been trying to think about more and more is how to take advantage of sort of AI logistics. I kind of do believe in self-driving, but I don't know about the trucks. You know, Jim and I have talked about this plenty of times before. I think when full self-driving is in effect, so many people's lives will be saved. Because everybody, I'm talking to people and they're like, yeah, I don't, trust a computer driving for me.
I don't
as
trust
they
them.
drink their fourth scotch and they're about to drive home. You know,
person dies in this country in a car accident every 12 minutes. Go on. Yeah.
Yeah, but I still don't know how the public is going to necessarily be okay.
Doesn't matter. The insurance companies are going to make it have to be, right?
Yeah.
Oh,
I mean, I just wonder.
Tracy, you of course know what a TPU is.
Tracy
You're smarter than me, right? You know, Tracy she's one of our friends, and she's smart as a whip. And of course, she knows what a tensor processing unit is. Thank you, Tracy. I miss you.
Yeah, that's basically it. I mean, I think the logistics thing, it's really, really important to think about that. I watched a video of somebody getting their very first Amazon drone delivery, and it was groceries. And they're literally watching this drone come down. They're standing in their patio going like this. And as the drone lands in the grass, the husband was like, really? You got to be in the grass? There's this huge patio right here. But then afterwards, they were like, we're definitely doing this again. So there's going to be a race toward this like automated delivery systems.
And does that help the grocery store chains?
What's that?
Is that? Are you saying that you buy the shares of the grocery store chains because they're going to be infinitely
more?
No,
because Amazon and Walmart are going to be way ahead.
Right.
Yeah. Walmart is now America's grocer. In terms of numbers, Walmart sells more groceries than anybody now.
That is crazy. And I just, forgot about that for a sec. It's wild how the landscape. What about, because we had someone else on, I can't remember who it was, saying banking is going to be completely revamped in Goldman. I don't know if you saw, by the way, I have a third of my trade on from Hillary Clinton wins the presidential election by the banks, because she's going to be more easy on the banks than Barack Obama. I still have a third of that position on. So it's been good. But Goldman, are the banks going to use AI effectively? Of course, right? Yeah.
Yes.
So, yeah.
We got a question from Remo, if I could throw it up, Jimmy.
Sure.
It's stock charts. If you see the economy as okay, Bob, what economic condition over the next few years? Oh, wait a minute, I'm reading that wrong. If you see the economy as okay, what economic condition over the next few years? What asset classes to be in? Wow. I messed that up.
See, I love this question because I'm a macroeconomist. I'm not an investment strategist. There are people on TV you can find. You throw any question at them, they say, I have the answer. I'm not that guy.
You just were making fun of Bob and I, were you?
Well, how about this? How about I change that question a little bit? If you see the economy as okay, what derails it? Are we in the process of derailing it? Do you think the Fed should cut? Do you think they should cut more aggressively? What derails it?
I think we have room for modest cuts, but it has to be gradual. If they go too quickly, at the same time that they're loosening up some of the capital regulations on the banks, things like that, we could get another spike up in inflation. So I'm a little worried about that. I think the risk more is towards inflation being inflation moderating over the next year. But when you ask me about downside risk, I'm taking things that might not be above a 50% chance, might be significantly below. The other thing to recognize is we haven't had a traditional recession, a real derailment of the economy for traditional economic reasons since 2001. It's been almost 25 years. Because we had, the global financial crisis was like a combination to me of like mark-to-market accounting, but really just like a bubble in housing foisted on the American public by both political parties.
Oh, no
like,
doubt.
yeah, totally. Like totally overbuilding, over mortgaging, everything. And then we had the COVID recession. That came out of nowhere.
Yeah.
So I wouldn't be surprised if the next recession is a come out of nowhere recession, not for traditional economic reasons like overly tight monetary policy or taxes or whatever. So what if China makes a play for Taiwan before 2027? And I don't think they will. But if there's a serious military confrontation in that part of the world, and Taiwanese ship or semiconductor operations get shut down, that's a global recession. I mean, try to replace a car or buy a car or a dishwasher or a microwave or a toothbrush without a chip. Yeah. Okay, everything. I mean, you have much higher inflation and much lower production. I mean, that is not a pleasant environment to be in.
No, I love that answer. Bobby, I have one more question. Are you done with questions? No.
Yeah, I'm done.
Okay, so my last question is this. When you said before that after inflation moderates a bit and then you could see it picking up and be high for the next 10 years, is part of that a Kevin Hastert criticism?
No, it is not. Okay, so in terms of who's going to be chosen for the Fed, I'm going to go into this for a little while. You're going to hear a little bit of a rant. I hope I don't go over.
We got about 4 minutes for our producers started. Yeah, we got okay. Yeah.
Okay. Kevin Hassett is one of the smartest people I've ever met. Can I say that about very few people? Okay. Brian Westbury gives me a raise. I'll start saying it about him.
Okay, good.
Okay? Yes. So, Kevin Hassett is one of the smartest people I've ever met. I don't think he's going to be chosen. And I know the prediction markets give him like the highest chance by far. I think it's going to be Warsh. And the prediction markets say maybe 15, 18% for Warsh, whatever, much lower than Kevin Hassett. I think Kevin Hassett could easily do the job. However, Kevin Warsh has two advantages. Number one, he would not be as immediately perceived by the markets as a tool of the Trump administration.
Yeah.
Even if he were. Okay. Yeah. And I'm not saying Kevin Hassett would be. Again, one of the smartest people, and I think he thinks independently, everything like that. Okay. But he might be perceived that way. Unfairly, but perceived that way. Number two, I think Kevin Warsh is a little bit more telegenic, and I think that matters to Donald Trump. So I think Warsh has a little bit better chance than people are giving him credit for, and Hassett is not quite as high. It's just my guess. Okay, I've been wrong about things. I can be wrong.
By the way, if you guys want to hedge risk in this, Predict It, who we are in discussions with and might become a sponsor of ours, Predict It Markets, go to that website. They are excellent at these sort of eventualities. Anyway,
but I think whomever gets the job, there's going to be, and this is true not just of the remainder of the Trump administration, it's for potentially a future Vance administration or a potential Newsom or Buttigieg, whomever. The president, I believe ultimately the Supreme Court is going to find that the president does, as a matter of fact, have more leeway in replacing these Fed governors than presidents have actually exercised going back generations. And that means the Fed is going to be more beholden to the White House than it traditionally was. And I think from an economic standpoint, that's unfortunate. I like an independent Fed. I'm not saying we've really had a truly independent Fed, but I prefer an independent Fed. But from a constitutional matter, I think the Supreme Court is probably going to find that no, the president does have the power to remove. Eventually, it's going to get to that conclusion when there's a case before it. And so we are going to have somewhat higher inflation. I also think 15 years ago or so, we witnessed the death of the low inflation consensus. The center left is okay with higher inflation. Like they just are, because they think, 2% inflation is too low. If you have a crisis, you can't cut interest rates, short-term interest rates fast enough and substantially enough to generate a boost in economic growth. So we need higher average inflation and a higher average short-term interest rate because of that. So across the board, it's a problem.
I love that. I love that answer. Bobby, we done? Play us out?
Yeah, no, I'm done. I just wanted to say one last thing. Our friend Widge is apparently an Eagles fan.
Oh,
and Friday we have Bears versus Eagles. So Widge, I may not read your questions next week. Just so
by the way,
you're in the penalty box.
By the way, I'm not from Chicago. I have to interject here, and I hate to say this, guys.
No,
you're
right.
The Bears are the worst 8-3
yes,
team in
you're 100%
history.
Right. We deal in facts, and that is a fact. The Bears are the worst 8-1 team in history.
Play who's on your schedule. That's it.
Yes. But again, I'll say this. If I have one drive to get us in position to win a game, Caleb Williams is in one of the top 4 in the league, in my opinion. But in the rest of the game, I'm not a huge, but he uses his legs at the end of games.
Yeah, don't get disappointed if you're not in the playoffs in January.
I know. I don't have this as a win on Friday. I have one of the Packers games as a win. So that gives us 9. And then Detroit at home at the end. It's going to be an intense game. It's at home. It's the last game of the season. If we beat the Packers once and we beat Detroit at home, I think we sneak into the playoffs. We shall see.
Bob, what do you got where you live? What's the special food? Because I'm going to send you deep dish pizza if the Bears are not in the playoffs. But you got to send me something. I don't know what it's going to be.
Okay. I hate to admit this on like national,
radio,
national news or whatever. But like I go to Chipotle like 4 times a week. And I think it's because I love the authentic Mexican cuisine they serve.
I'll tell you what, if the Bears don't make the playoffs, we're sending you deep dish pizza. If they do, you send me a gift card of your denominational choice for Chipotle.
Absolutely. I'm happy to do so.
Done.
All right, I gotta go. I got a bar to run. I'm leaving. I gotta go to the bar. Thank you guys so much for joining us. This again, I when I looked at the clock and we were 55 minutes in, I was surprised as hell because this was a fun conversation. It went by in a snap. He is Bob Stein. He is the deputy chief economist for First Trust with our other pal Brian Westbury. That's Bob Iaccino. I'm Jim Iuorio. This has been Tradiers, the Trader's Edge. Thank you guys so much for joining us.
Pleasure.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.